Hello, everyone, and welcome to a new episode of eCommerce Growth Show. I'm here with Jesse Horwitz, which is an entrepreneur and an author. He has a large experience in building a D2C brand. He's the founder of Hubble Contacts. And the meaning of this episode is to pick Jesse's brain about how to build a D2C brand and how to grow an e-commerce company. Jesse, thanks a lot for being part of the show.
Thanks for having me today. Great to be here.
So the first question is how you got started. I started to read your book, which is Selling Naked, and it sounded impressive. But I want you to share the story with our audience today as well.
Yeah, sure. Definitely no grand strategy. So my background, I was on the investment side before I was doing e-commerce. I was at Bridgewater, and then I was on the investment team for Columbia's endowment for a few years. I traded with another Bridgewater guy for a year in between until the cash balance was low enough that needed another job. So that's how I ended up on the endowment side. And the great thing about endowment work's very interesting. You get to look across all sorts of alternative investment asset classes, venture capital, real estate, private equity, quant trading, whatever. But also regular hours, 8 to 5, 8 to 6. And so, predictable hours meant predictable time to help friends kick the tires on their own projects. So during the time I was at Columbia, I worked with a friend from college who had been at Zynga, who was working on a dating app that was sort of gamified. I worked with a friend from Bridgewater and from law school on a bone marrow banking startup. That first round ended up backing that I'm on the board of now. That's called Ossium. And I worked with another friend from Bridgewater on a contact lens subscription business, a friend named Ben who had gone from Bridgewater to BCG to Harry's, the shaving subscription company. So I was just, using my nights and weekends to help different friends kick the tires on their ideas. And it was, late 2015, early 2016. There was a lot of capital going into box subscriptions. And so it was just a good time to bring something to market and, high investor demand. And we kind of went for it.
Excellent. So tell us about how you got into this industry of contact lenses. To give you some background, I've been working for 4 years as well in this optometry industry, but that was 20 years ago. As a freshman, and on the side, I was building my own my first company to bring broadband internet in Bucharest, Romania. So,
there we go. Obviously a lot of sort of industry specific differences, but high level, it was a category that seemed to line up well with sort of subscription economy. It was naturally recurring product. It was low shipping weight, high margin. And I think that's something you've seen sort of between the first generation of direct-to-consumer businesses powered primarily by ads on Facebook and Instagram, and the second wave is the first wave, people were still somewhat applying retail logic. So you had products that were high percentage gross margin but low dollar margin, like razors, and people thought, oh, this is good because it's a high margin product. And I think if you look at the businesses that were started sort of 2016 onward, and more so over time as its capital kind of pulled away from the sector, and there was more and more focus on early profitability. People understood it's not just that I need a product that's 70, 80% gross margin, but it also needs to be high dollar margin because I need to A, cover my shipping costs, and B, cover Facebook CPMs. And it's just hard. It's not impossible. If you have a super high affinity product, maybe you can do that in a category where your lifetime value is 20, 30 bucks per customer, but it's really hard to make the math work on that. And so, I think across the board, you've seen advertisers understand that they need $100, $200, $300 plus lifetime value to play with, so that even if they're executing everything right on the performance marketing side, they have enough, they're generating enough value for the consumer that they have something to work with on the ad budget.
So you're a proponent of paid acquisition for the whole period or only at the launch? How do you see this? Because there is a lot of debate about acquiring customers way too expensive, and I can understand that in this industry where you have the high margin, and I've been there as well, it pays off to cover the CPMs in Facebook. But for other kind of products which have I don't know 20 to 25% margin, does this work as well?
I'd love to get the customers for free. I just don't know how to. I think it, every bit. I don't know. I might just not know enough. I don't know many e-commerce businesses that don't have a pay strategy at their core. I know there's certainly good businesses operating in high six figures, low to mid seven figures, where paid is less important. But oftentimes there's some sort of terrestrial tie there. It's a retailer that built their brand sort of offline and is pushing that onto into the digital world. And so that's what their source of traffic is that investment they made for years in leases and sort of local presence. You need the traffic from somewhere, and all the traffic is sitting inside of a couple networks, and those networks don't allow you very much organic reach. If you want people to find out about your product, you generally have to pay for the privilege. That's not to say that other things aren't important, but I think they're all sort of an multiplier and an outgrowth of a successful paid strategy. So if consumers are really enjoying your product, they'll tell their friends about it more. If they're seeing a lot of value there, they'll tell their friends about it more. They'll come back and buy more. And so it's not that the rest doesn't matter. It's just I think if you were to really trace it back, you'd find very few customers that it didn't start with an ad impression, who didn't trace back to an ad impression, even if it was an ad impression delivered to someone else.
Okay, so that means you can justify the investment by doing advanced attribution. And that also means that you should be using things like customer experience tracking, like NPS or other things, and the customer lifetime value, so that you can put it in balance with the customer acquisition cost. Have you done this at Hubble Contacts at the beginning?
Yes, for sure. It's one of the things. We basically just sit there all day squinting at a customer lifetime value across any e-commerce business that I know, because that's what you work backwards from your lifetime value to what you can afford to bid for a customer. And it's tough because your lifetime value obviously isn't a static thing over time. It varies as you evolve your offering. And so there's always, and as conditions on the ground change, so there's always uncertainty around that. But yeah, you've got to start with the lifetime value, and then that tells you what you can afford to pay for the customer, as opposed to the other way around.
However, to understand customer lifetime value, you need to have some business cycles. So you need to have a few business cycles. In contact lenses, it's I don't know. You have dailies. You have I don't know. Every month you should be recharging. But in terms of the other products, what is your let's say suggestion around finding the CLV?
Yeah, I think the thing I see most advertisers doing, where when you're not talking about subscription, where you can look at churn, and when you're talking about repurchase on a single order product, is generally the conservative thing to do is to budget for first order profitability, and then maybe you get very high conviction over time that you can bid up higher than that. But that's when you've been around a few years and you actually have good robust data on repurchase rate. I think the other thing is it helps both, whether you're subscription or single order, it helps to have enough old cohorts throwing off profit dollars with minimal marketing investment so that you can bid up higher. So if you're in the repurchase business, let's say you're in a business driven by repurchase and you think, I get one order, but up front, but I'm going to get 2 or 3 orders lifetime. If you wait a couple years and for those repurchase orders to come back, and for that, and for the value of those older cohorts to flow through, that's giving you an extra budget of margin dollars to bid with, if you do want to bid up on the acquisition side.
Do you think that's actually affecting Casper and folks like them?
Um,
The fact that the usage is pretty long. I mean, to buy another
yeah,
mattress.
for sure. Yeah, it's tough. I know Casper's, tried to push into the little, into the lamp, and some other products. But I think it's also it's tough because repurchase cycles are super long on the primary product, and the great thing about mattresses is the primary product throws off a ton of margin dollars. The thing that's bad about an anchor product that's so profitable is it's very hard to move the needle meaningfully with cross sell because think about something like a 10% attach rate is pretty high and and pretty successful in terms of getting somebody to buy more product from you. If you have one product that throws off 400 margin dollars and you have another product that throws off 40 and the cross sell rate the cross attach rate is 10% or something, then you're only moving your margin dollars per order up from 400 to 404. Exactly, and it's probably even worse than that because generally which is always the challenge with cross-selling either in checkout or post-checkout, you're creating some additional friction, which might, if it's a subscription business, maybe that increases churn a bit. If it's a manual business, maybe it decreases repurchase a bit because you're putting more email in somebody's inbox if you're doing it post-checkout. And if you're doing it pre-checkout, it probably hits conversion rate a little bit because it's something else for somebody to think about. So it's hard, if you're not coming to things that are going to move the order value up 5-10%. It's hard to net positive because you're going to there's a decent chance of taking some conversion hit.
Yeah, so you're betting everything on the acquisition game. Jesse, tell me something regarding the other business models. So we have the direct to consumer, which is great, and we have the subscription models, but we also have direct to consumer where you don't have this kind of subscription, like shoes, for instance. What would be your insights for e-commerce players that are in the D2C, but can't do something like a subscription?
Yeah, I mean, I think the logic is still pretty similar, which is I always say it's tough. If you look at direct to consumer businesses, a lot of the ones that I know that have worked well it's the value version of a premium product. It's hard to be, if you're the value version of a basic product, your budget, and there's nothing wrong with that. It's just hard to make that work in an e-commerce world because of the need for margin dollars. If you're the value version of a premium product, then you can still be a reasonably big ticket size. And I think the challenge is a lot of it, some of it comes to sort of the marketing blocking and tackling, keeping your G&A low, being disciplined about where you're putting your marketing dollars. But at the core, you actually need pretty good product and supply chain capabilities to do the value version of a premium product and have enough margin dollars left over. You have to be pretty good at product and supply chain. And so a lot of the businesses that I've seen that have pulled it off well, either the founders have some sort of category expertise or background there, like think about a company like Purple in the mattress space, which has really done nicely in a crowded field, or the founders have partnered with somebody who can bring them that expertise. But the expertise is important because you can be new to a space and make a nice product. But oftentimes when you do, since you're new to the space and you don't have the same buying relationships and and scale with manufacturers and all the rest, your newness to the space means you're going to have terrible COGS. And if you're very high on the cost of goods, then you're not going to be able to generate compelling pricing for the consumer, even if the product's nice. Or if you do, you won't have margin to be left over, for the math to work.
Excellent. Yeah. Jesse, what do you think about dropshipping? Do you think this is a dead business model?
No, we do, on Hubble, we do a fair amount of drop shipping. We have inventory of our brand, of our Hubble brand lenses, but then we drop ship for, we also sell, the, other brands of lenses and we drop ship on those. I think especially if you think about trying to increase, I think it's hard to build a business that's entirely drop shipping. You know, it's just like less, you know, what are you bringing to the table? But I think especially, and Brooklyn's done a nice job with this too, especially if you're trying to increase conversion rate on site, increase session value, and increase catalog depth. If you have, you know, sort of some core branded products that you've developed yourself, and you know, and you're trying to maximize the value of those sessions that you're buying from Facebook and Instagram, adding more product to the mix is effective, and it's often faster to do that drop shipping than it is to develop it yourself and take the inventory and tie up the capital.
Yeah. In terms of capital, now that you're touching this subject, you're a big proponent, as you are coming from this space of raising money. Why?
Well, it depends. You know, it's funny. There's a lot about that in the book, but that also, like, books just take forever. I started the book, you know, two and a half years ago or something, and there was still a lot more capital in the space. I think, you know, you're always weighing different options. 3 years ago, there was a lot of equity capital in the direct to consumer space, and so if there's equity capital available on reasonable terms, and you can ramp your business that way, that's great. Today, there's probably less of that available, but there's other ways to access capital in the space. And you know, and honestly, when I've been advising businesses who are getting off the ground now, I've been I generally push them more that direction. You know, and that would be generally it's hard to do without some amount of equity. So you generally see a little bit of angel equity go in. But in terms of what else people are doing to finance their businesses, you have the alternative capital providers, you know, Clearbank, Assembled Brands, other groups like that. You have more and more of the capital coming, you know, implicitly or explicitly from the supply partners, whether that's the supply partners investing or extending more, generous working capital terms, or trading some of their margin dollars for equity in the business, which also frees up cash. You have, and then you have the consumer providing financing in the form of, pre-order and sort of, longer fulfillment cycles, which works in a lot of these categories. And so I'd say, the environment has shifted and financing has kind of shifted along with it. But what's been interesting to watch from my perspective through all that is, lots of good business, many good businesses, more being started in sort of tighter equity capital environment, than I was seeing 2-3 years ago.
Yeah. Still, there is, the current environment, of course, is much more difficult to raise money once you have only an idea, or at least you don't have a great track record. In the sense of raising money, what do you advise e-commerce entrepreneurs to do in order to raise money? What kind of data they need to have prepare in advance so that we can show a healthy business model?
Yeah, I mean, look, obviously the best is you have your business live already and you have compelling economics, and even then, it's still it's still not super easy today. I flip it a little bit another way, which is to think about fundraising as just as not just a discrete process you go through, but as a part of your ongoing responsibilities. To the extent that you think your business is going to require capital, you should be meeting with investors on an ongoing basis, trying to establish 3 or 4 new investor relationships every week, honestly, for a few reasons. One, talking to more folks means you're getting more feedback, which means you're identifying what's weak or strong about your business model. 2, investors are often a good source of ideas or referrals to other sources of capital that might be appropriate. And 3, while different, I think there's some flukiness and there's some randomness. So maybe if you meet with 10 consumer funds, 9 of them won't like you and the 10th will go crazy for you. I think what happens more is investors of a certain type will generally look at a situation similarly, but that the community of investors is more heterogeneous than you realize. And so like, depending on the quirks of your business, maybe you don't resonate with consumer investors, but you resonate with some sort of industry specialist, but life sciences or something like that. Or maybe there's just capital types that you hadn't considered, and you learn about those and build those relationships through more traditional investors. So I think it's just part of your you're always working on your product market fit, and you're always working on your business investor fit. And just the same way that you want feedback from consumers every day, you want feedback from capital broadly every day to understand how your business is sitting up there.
Okay, makes sense. What do you think about the transparency and the clarity over the growth factors? I mean, the initial growth e-commerce formula lied around the traffic and conversion rate, then it got more towards customer experience and customer lifetime value. Why do you think this happens so slowly? Because most of the e-commerce entrepreneurs that we see out there are making only the game of CPCs and cost conversion rate rather than looking at the whole life cycle of the customer.
I think founders are getting better there, and especially as when there was lots of capital flooding into the space. I think A, you didn't have to be as disciplined about it. B, you had incentives to focus on sort of fast feedback metrics. Because those were the ones you could point to keep bringing more capital into your business. I think now that it falls more and more on founders to really operate their businesses as businesses. They're thinking about how it all waters through to a P&L, and being focused on that P&L gets you focused on sort of the further out for the only way you get to profit, to be in the black in your P&L is having enough, is having customers that are worth more than they cost and having enough of them to cover your G&A. And so I do think more and more founders are more focused on that.
Yeah.
Otherwise they can't make payroll.
Yeah. However, P&L alone is not showing you the reality, right? Because these are not showing you the growth factors of a business. This is showing you the results of the former growth factors of your business. And there is, I personally think there is some lack of education. I had a guest just a few weeks ago. He brought his company until 11 million euro in revenue in 8 countries or so, and eventually they couldn't pay the bills anymore because their customers weren't come back, and they weren't tracking things like customer retention and payback period for the customer acquisition. Even though the payback was great, they were growing 60% year over year.
Yeah, well, and I think, so I agree, and I think there's also some none of the math on any of this is that complicated. I think some founders just get intimidated when they shouldn't be. So like one of the things I always like to talk about, which we focus a lot on, is using IRR to look at CAC LTV, and how you can sort of the little corner cases that pop up that can be misleading, in terms of months payback or some sort of 3-to-1 rule. And so the way we generally look at it is we'll lay out our cash flows, marketing expense to acquire customers, a negative cash flow at the start of the customer life. And then you have the positive cash flows coming back, month by month. And we're looking to generate an attractive IRR across all those cash flows. And it's funny because you'll spend time with investors, and investors will build very complicated models on your customers and your cohorts that are loaded up with assumptions, and it's far too complicated to capture a relatively simple business. But then at the end of that, having gone through all that exercise, they won't just say, okay, I made this overly intricate customer model for this business. What's the IRR? They'll say, oh, is it 12 months payback, or is it 6 months payback, or is it 18 months payback? And it's always sort of funny, because it's like, why build this convoluted model if you're just going to apply, a rule of thumb to it at the end?
Yeah, I totally get it, and I see this bad habit happening. So, Jesse, in terms of let's say the the baddest assumptions that you've had throughout your entire life as an entrepreneur, which were those ones? Or some of them.
Yeah, I think I think a lot of where we've gotten caught is it being is assuming that the financing environment is going to be stable. So sometimes we've on some businesses we've moved very successfully on the front. So like Hubble, after we raised in mid 2018, we moved the business to cash flow positive, and we said this is going to be the last money we have. We're going to behave as if this is the last money we ever raise, and we managed that transition fairly smoothly. But there was also an adult diaper business that we were involved in called Willow, and and on that business, the economics looked, the problem with adult diapers is you need scale. You need meaningful scale to get strong gross margins. And so, we sort of just assumed that we could burn our way to that scale, and that cohort value would increase substantially over time as we had, more cohorts and more scale and more, and better margins as a result. And, there just wasn't sort of financing demand to kind of, and it would, it was a meaningful amount of risk, I get it, to, sort of burn our way through to that kind of scale. And so that's a case, which I've seen a couple times where you assume that investors want a certain thing, and that you can sort of make your business plan on that business and on that basis, and maybe that desire is there or not. And that's why it's helpful to regularly, just as point of process, be talking to folks, filling out the market, understanding, understanding where sort of the investor mindset is, because take a different example to the plus side. It's like, okay, Peloton was one of the few good IPOs last year. It was an okay IPO, and now it looks like a really good IPO. And anything in sort of that connected device health, fitness space has had lots of investor demand all of a sudden. And like, I don't know whether long term that's a great space or not. But if, as a founder on the ground, it's important to know that kind of thing as you're making capital plans for your business. Should I be planning on having more or less access to capital? Based on sort of what the trends are with the investors.
Yeah, that totally makes sense. However, we have some other let's say examples in this space. For instance, here in Europe, the access to capital is way harder than it is in the US, and the bad assumptions are differently. Like they are looking at the European entrepreneurs are not even considering to raise money until they reach a certain scale. So that means they are losing the opportunity window, and they eventually find themselves into a mediocre company that they are struggling to
yeah, well, and it's unfortunate also because it meaningfully constricts who can be a founder then, because it means it means you need, at the very least, you need even if you can bootstrap the business entirely, you still need to cover your own living expenses. And so if you don't have some level of capital available to cover kind of a base salary for you and your co-founders, and it definitely limits who can try to start a business.
Yeah, and you go into the downward spiral of self-esteem, and I can't make it, and that's how you collapse. Jesse, we had in the last weeks a lot of demand on our product that is doing retail analytics, and we've seen some things around the chance to place the next order. So there is a pattern around the chance to place the next order after the third order, not for the subscription models, even though there is another conversation as well. After the third order, the chances to place the fourth order are skyrocketing. So mainly you have an customer which is already, let's say, established.
Mhm.
He has the habit forming. The buying habit forming is done, but few companies are focusing on the first to second, second to third order, and they are somehow obsessed about acquiring the first time customers that they are not even tracking this. And what would be some suggestions to this kind of companies?
Yeah, I mean, I see it, I see it with a couple of the businesses I advise, where they've done a really good job, sort of increasing customer value over time and getting more value out of already acquired customers. And the two things, I mean, it sounds very basic, but the two things that I've seen that drive it, one is, robust email marketing campaigns. Those are the customers you've already paid for. So, so why not be hitting them again? Why not be reaching back out to them, and and expanding product catalog? And to me, expanding product catalog is great because you think about, okay, I'm going to put more money. I can put more money into just paid acquisition, and but that's pushing on a string at some point, and people complain, oh, the CPAs are rising, but it's not that the CPAs are rising. It's that you're trying to shove more money in there you know than you can profitably deploy, and that looks like your CPAs are spiking when you're just pushing for volume that isn't there. Where if you take the dollars and you put them to more inventory and deeper product catalog, that's both going to increase conversion rate on first sessions. So it's going to, make your paid marketing program more efficient, but it's also going to allow you to increase value on all your existing customers, because just remarketing them can drive some value, but especially if you're coming back to them and you're saying, look at this new collection, look at what we have to offer you now, look at these new accessories, whatever it is. Um, now they really have a compelling, they're already your customer, they already like you, they now have a compelling reason to come back to the site and buy again.
Yeah, in terms of let's say some story that you can share with us around improving customer lifetime value. Do you have a real example on this topic? Because
Sure. It's I'm a board member to a swim company called Andie. Andie's just done a great job. They're very plugged in with their customer. They keep launching new collections, and it's this virtuous cycle. You expand the collection. That means that your addressable audience is bigger. That means you're driving more value off your existing customers. And that allows you to increase the marketing budget, and it's just a flywheel that keeps moving. Then another business that's done a great job with exactly that dynamic is Bombas. Bombas has Bombas started off selling a few socks. Now they sell a lot of socks, and they've just continued to expand the depth of their sock portfolio, and they have a good pulse on what their customer wants. So they've done a good job kind of placing those bets on product expansion. I think people are often too quick to go into other product categories. Not that there aren't successful examples of that working, but I think oftentimes it's easier, more fruitful to try to do more in like your customer trusts you in XYZ category, and is there for XYZ category. So like if you're an apparel, if the Bombas example, and I think they might do a bit more than socks now, I don't remember, but they spent a lot of time just going deeper and deeper with socks versus launching a sweatshirt and sweatpants and a bunch of other products. Because the easiest thing to do is we're buying traffic for people who want socks. Let's have more socks there.
Yeah. So there's a thin line over here. to not go too much into the same category and to actually analyze. So that means you should
Yeah.
be A/B testing. Have you ever considered or done different cohort analysis, cohort A/B testing? So to onboard customers differently and to propose different kind of products and offerings.
Oh, totally, all the time. That's our, that's a lot of our job as a business is to, is to try to figure out how to frame the offering. What pricing makes sense. How do we merchandise other products alongside. Always have to be fiddling around with things like that.
Okay, but in terms of the uh, let's say how you differentiate a different customer service, because the improving the customer lifetime value doesn't mean only to change your uh, offerings and the way you talk to your customers, but also to change the operations around these touch points, and maybe to add many people, do a phone
Yeah,
call after 3 days after the first purchase, check on
yeah.
the.
One of the things we've been working on a lot right now is how we work with the phone service team, and giving them more incentives to resolve customer problems.
Yeah.
Enormous lift on that's enormous lift on the cancellation front. Then if you can resolve problems for customers, then you can hold on to them. Then you can hold on to them longer. But that requires more training and more investment and more bonus structures for your customer service agents. So that's an area we've been spending a lot of time on right now. Which is purely a retention it's driven out through the customer service agents, but it's purely a retention marketing initiative. We've also started thinking more about, we've been around long enough now, remarketing to canceled cohorts. Which is whole different math then, because those are folks who've engaged with you in the past. On the other hand, maybe value there is going to be lower because they canceled with you once. So experimenting with that. But that's exactly as opposed thinking about everyone out there in each part of the journey is prospecting, active customer, potentially canceling customer. What can we do to hold on to you? And then canceled customer, what can we do to sort of restart that relationship? Has been an area of focus.
Do you constantly monitor something? So I've seen a very interesting technique to constantly monitor the top 3 reasons to churn, and to always addressing the first one, the most important, until this is not a problem anymore. Have you done this, or what is your take on
Yeah.
this?
And one of the things, like this is something we've been working on now. And again, it's nothing super complicated. It's, listening to your customer. One major cancellation reason is just overstocking, which is fine then, because it's easy to give people, pause options then, and it's much better to hold on, to let somebody, pause for 6 months and restart than it is for them to cancel. And that's sort of solving the problem better on both sides. You're resolving the customer's overstocking issue, but you're also keeping that relationship.
Yeah, and the future lifetime value from that customer as well. Great, Jesse. Regarding the what excites you at this moment? So you've been in the VC world, you've been in the entrepreneurial world. Now you are doing a great job contributing to other entrepreneurs, helping them to navigate through these terms and buzzwords so that they can actually make a sustainable business. What's next for you? What excites you at this moment?
Just always kicking the tires on spending a lot of time on contact lenses and and vision, and then just always fun talking to people about their businesses. I think it's been the last. It's a lot more fun talking to teams who really are very scrappy and who have sort of, made the business work with minimal outside resources, because the discipline that requires and the thoughtfulness that requires is pretty extreme. And and so those conversations are a lot of fun, and you're necessity because of financing the space, you're getting more of that. So I spend a lot of time sort of talking with different founders, and always curious to hear what they're building.
Yeah, excellent. So in terms of the, let's say, team, how do you build a team to do all this stuff? Because you can't be a one man army. You need to understand the data insights. You need to craft different journeys to customers. You need to actually do support. How do you craft a team for a D2C that is just starting off?
Yeah, I think I think a lot of good D2C companies look more, the team's thin, and you look more like a conductor than you do, this big organization. Because the thing that's great is, there's all these modules everywhere else that you can pull together. Certainly on the software stack, you have whether you're using Shopify or Magento or something else, or Stripe, or you have Stripe, you have Braintree, you have AWS or Heroku. Facebook and Google provide lots of nice tools. And so you're cobbling together as a fairly standard stack of third-party providers. And then as you sort of look across the operational, roles you need to complete, it's fulfillment, where everybody's generally working without, an outsourced 3PL, with a third-party fulfillment provider. It's customer service, where you can have those capabilities in-house, but I'm also an advisor to Resolve CX, which is an outsourcer for customer service for direct-to-consumer brands, and there's other businesses sort of in that space. Marketing, there's lots of good agency talent to work with, and external buying groups, and so I think a lot of you don't need to have that much internally. What's sort of left with internally is accountability and capital allocation. So you obviously care more about whatever your relationship to your business is different than your vendors, and so you're there somewhat as a taskmaster, and making sure that the business is actually driving value from all those relationships. And so that's sort of being a sophisticated customer of the B2B services that the business requires. And you're there to learn and hear from the consumer, and think about how you can iterate your work with this network of vendors, to continue to better meet that consumer need. But I don't think you need like some big in-house team. And I think the fact that you don't is a lot of what's made it possible for businesses to be profitable earlier with less scale.
Makes sense, and I'm a big fan of keeping it as small as possible, because that means recurring costs, and of course the external vendors and tools are far more predictable, and you can cut it short very, very fast.
Exactly, and it means that and then it means you can pass on the cash that frees up to the consumer, which is giving the consumer what they want. So that's improving the efficiency of the marketing budget and all the rest.
Yeah, you've said about outsourcing customer support. What are the pros and cons for that? The pros, of course, it's much more easy. Let's say you don't have to train everyone and track their performance. There's a company doing that for you. But what are the cons?
I think it's like a lot of these things, which is there's some amount of expertise that's built out in the groups that you're outsourcing to. So if it's customer service, it's how to sort of manage distributed teams, and how to and decent referral networks to source new agents who are going to do a good job for your business. If it's marketing, it's not just the Facebook side stuff. It's oftentimes now a lot of landing page work. If it's retail, it's obviously a physical asset, the fulfillment center that that the team owns. I just think there's going to be some problems specific to your business, and you have and you should have ownership over those, and deal with those. But like, no need to overcomplicate things, and most of the problems that you encounter as a direct-to-consumer business are somewhat generalizable, which means there's probably third-party groups that are dealing with it with more scale for multiple companies, and that's ultimately a more effective, efficient way to solve the problem at the end of the day, because it's if I'm it's like anything else in the economy. There's just efficiencies of scale and knowledge sharing across an organization that has multiple clients versus just one.
Yeah. Tell us about your relation with money. So what do you think about this? Let's say, do you see it as a mean to do something else? Because at some point you need to define your relation with money, and I've seen that a lot of entrepreneurs are being trapped about this, not keeping the score of their internal growth, let's say. So they are somehow transforming into an avatar that needs more zeros instead of understanding how to grow on other aspects of their lives. And I'm on a lot of forums with e-commerce owners, entrepreneurs that are 7-figure, 8-figure. Let's go to 9-figure, 10-figure. What's up with the figure? Like,
yeah, my grandma always says, "Rich or poor, it's always good to have money." No, but I think. I think it's sort of funny to to live in, because it's basically it's this giant digital Main Street, and to have these, one of the things that's nice if if you're doing well as an e-commerce operator is like the wealth and the scale of something like Facebook or Amazon or or Google is just like so comically large that it seems silly to worry about money much beyond your whatever you consider your own personal needs, and comfort, because like what, unless you're planning to start a $1 trillion platform business, why tie too much of your ego up in the in the digits and the commas? There's going to be some other jerk who's imponderably richer than you are anyway. So so I think more it's fun. It's fun to see the businesses actually working, and it's very satisfying and gratifying when you're like whatever the scale is. Yeah, obviously more scale is more fun than smaller, but to see everything waterfall through to real workable economics, where everyone's salary is getting paid, there's a little bit left over after that, and you can say like, okay, we actually made a real business. This is something that in theory could be sustainable. Where the math is all working. And there's something satisfying about that.
Yeah, make the math working.
Yeah.
Jesse, regarding your position, you are a privileged entrepreneur because you're coming from let's say their side as well. So you've been into the VC side, you've seen the work, that world. You know how their paradigm is actually, and don't you think that you've got this unfair advantage, and you make it sound very easily to raise money, to use those money to make it a working company by using VC money. What are some first? Am I right? Can you be right? And second, tell us how you actually used this ammunition so that you can convince the VCs that supported your growth.
I think, yeah, I mean, I think the biggest thing is, and I think in theory this is something other folks can do, but easier said than done. It's like at the end of the day, they're just people, and it's like any community. If you've got if you've gotten to experience them just as people, then it's easier to sort of have calmer, lower stakes interaction. And I think that's in terms of like practical things that founders can do, being aggressive about reaching out to lots of investors, and then just not overawed by the interaction with them, is the biggest thing. But that's again, it's easier said. It's easier said than done, and it's certainly probably I'm sure it is easier for folks with with access to more investors. But one of the things I always like to remind founders is I've never known a business that has failed to raise because they ran out of investors to talk to. It's very easy that I know businesses that have failed to raise. It's easy to sort of freak yourself out and get on, oh, this meeting is make or break, or that meeting is make or break. Just always remind yourself when you're talking with investors, none of the meetings are make or break. You might not raise money for your business, but that's not because you run out of investors to talk to. There's always going to be more investors to talk to. The reason why when a business fails to raise money, it's because the founders have had interactions with enough investors to conclude that they're not going to raise money. It's not because they reached some point where they were like, well, I think this could work still, but heck, who am I going to talk to now? And so like, I think at the very least, you can treat each of those individual conversations as relatively low stakes in a pretty deep pool, and just not psych yourself out of it.
Yeah, so what you're saying makes a lot of sense. As an entrepreneur that raised money, I totally agree with you, and I recognize this pattern that the battle is in the mind of an entrepreneur. That's where you should be focusing on.
Yeah, and look, I mean, for as easy it is as easy and reasonable as it is to like to make fun of them, like they're not totally, they're often right, and B, even if they're not, it doesn't matter, because it's still where the money comes from. At some point, you have to hear the feedback and say, okay, maybe this just like don't get too attached. I think it was Faulkner said, kill your darlings. Maybe it just isn't the right business. Which doesn't necessarily mean it wasn't a business that could work. It could be a business that requires capital where there's not enough capital available, in which case it's the wrong business. So life is long. Think of another idea then. Or maybe you're not the right founder at that point in time, which is tough because there's definitely biases and less savory things that come into play there. But it could just be as simple as like, okay, I should go, whatever, I should go spend a couple years working a particular kind of job or with a particular kind of organization that's going to make me look more credible as a founder. And then after that experience, I can come back out to the market and, and see if I can fundraise then.
Yeah. Jesse, regarding your book, so you've told us that it took you 2.5 years to write it. Tell us how it was the process, and tell us what can we find in
Sure. So the book's called Selling Naked. It's hopefully a pretty practical guide to step by step through getting a direct to consumer business up and running. Publishing just takes a long time. So I worked with Crown, which is a label under Penguin Random House. Started talking to an agent in late 2017. I had a contract in mid 2018. Had a draft in maybe 15 months after that, and then it's another like 6 to 9 months to final publication. It makes it very hard. I don't envy the job of a publisher because it's very hard. Imagine if in advance you had to predict what people might want to read. At that point in time, it's I understand why it's such a challenging. I don't quite understand why it takes so long to get to print, but I do understand why, given that it's a very challenging industry.
Yeah, and can we find inside? I've started to listen to the book, 1.25x. Couldn't finish it. It starts great because it looks like there's a lot of personal experience out there. But let us know.
It's just, it's a lot like the conversation we've been having today. It's hopefully practical advice on capitalizing your business, on thinking of ideas you might want to work on as a direct-to-consumer founder, on testing those ideas, on launching a business, on operationalizing a business, even down to the level of walking through how to calculate an LTV, how to build out an IRR model, all the different things you have to think about in margin, all the fun emotional health things that starting a business tends to engender. So my best attempt at helpful advice.
Excellent. So, Jesse, thanks a lot for being part of e-commerce growth show. It was great. If you want to find Jesse's book, you have the link here in the comments. Where can people reach out to you if they need your help or if they need to simply follow you?
LinkedIn and Twitter, I'm pretty responsive on both.
Excellent.
That's Jesse Horwitz.
So that was it, folks. Thanks a lot for watching, and see you in the next episode next Thursday, 5 p.m. UK time. Thanks a lot, Jesse, and all the best from Bucharest.